Okay, so you've probably heard the word exchange trade fund or ETF tossed around by adults. Don't worry, we got you. In the next few minutes, we're going to explain what an ETF actually is, how it works in the real world, how it makes money for itself and for you, the hidden costs, how you can lose money, and even some real examples of the smallest and biggest ETFs out there. No jargons, no boring lectures, just money literacy made simple and useful. Let's start with what is an ETF. An ETF is just a basket. Instead of buying one company's stock, like only Nike, you buy a basket that has Nike, Meta, Visa, Nvidia, and more. So one ETF share equals a little slice of all of them. It's basically the Spotify playlist of investing. Who creates ETFs? ETFs don't just appear magically. Big financial companies like BlackRock, Vanguard, State Street design them. They decide what goes in the basket, like this ETF will hold the top 500 US companies, or this one will track clean energy businesses. Then, they put it out on the stock market for anyone to buy, just like a regular stock. What are the types of ETFs? Just like ice cream at Ben & Jerry's, there are different flavors of ETFs. Stock ETFs, which are baskets of companies. Bond ETFs that basically lend money to governments or businesses. Commodity ETFs, which are baskets of stuff like gold, silver, or oil. Theme ETFs, which are just for gaming companies, space exploration, or even cannabis stocks. Basically, you can invest in any vibe you want. So it's kind of like picking a playlist with rock, hip-hop, lo-fi, or pop. Real-world examples of ETFs. Some ETFs are massive. The biggest is SPY, which tracks the top 500 US companies. It's worth over $600 billion. That's like the entire GDP of a country. On the flip side, there are tiny ETFs with just a few $1,000,000 in them, sometimes so small they get shut down. So ETFs can be giant whales or tiny guppies. Here are 10 examples of popular and frequently bought and sold ETFs around the world. How ETFs make money for themselves. ETFs aren't charities. Every year, the companies that created the ETFs charge a tiny annual fee, usually under 1%. That sounds small, but when millions of people invest billions, those pennies turn into serious money for the ETF creators. How do ETFs make money for you? For you, it's simple. If the basket of companies grows in value, your ETF grows. So if Apple, Netflix, and Nike all go up, your ETF share is worth more. Some ETFs also pay dividends, tiny slices of company profits, directly into your account. Think of it like refills at the soda machine. The cost you pay. When you buy an ETF, there are usually two costs. One is the annual fee, that small percent we talked about, and two is the trading fees if your broker charges them. Many apps now have zero fees, but it's worth checking. Compared to mutual funds, ETFs are usually way cheaper. That's why they're so popular. How you can lose money. ETFs aren't risk-free. If the companies inside do badly, your ETF drops too. Bought a tech ETF before a crash? Boom, you're down. And if you panic sell too early, you lock in losses. So yes, you can lose money. How to buy an ETF. Buying one is simple and super easy. You don't need lots of money. Just get an investing app, search and type the ETF's ticker symbol, like SPY for the S&P 500, and buy shares, just like buying Walmart or Microsoft stock. So that's ETFs, the playlist of investing. You now know what they are, who makes them, how they earn money, how you earn money, the costs, the risks, and some real-world examples. If this made sense, smash that like button, hit subscribe, and drop in the comments. Would you rather own one stock or the whole playlist? Remember to follow the School of Money for money literacy, made easy and useful.